Green power equipment manufacturers had become accustomed to bad news, but the tide seems to be turning. Global investment in renewable energy, which slipped in 2012 and 2013, rose in 2014 to total around €201 billion, representing an over 16% rise from 2013 and indicating that further growth is on the horizon for the industry. Admittedly, this investment is not quite as high as that seen in 2011, but it should be noted that renewable energy technology costs are falling year after year, meaning that this increase in spending should lead to exponentially greater growth in capacity. This said, it remains true that renewables occupy a small slice of the global energy mix. Only 6.7% of consumed energy is generated by hydro and a tiny 2.2% by other renewables, while oil, coal, gas and nuclear make up the remaining 91.1%. Nevertheless, renewables are currently seeing strong growth in consumption. Non-hydro renewables grew by 16% in 2013, albeit from a low base, and hydro by 2.7%, while other energy sources saw considerably slower growth. One of the primary drivers behind the industry's growth has been China. In 2004, it invested a mere €3 billion in renewable energy, far behind early adopter Europe's $23.6 billion and also lower than the US's $5.4 billion. However, in 2014, things had become very different. China is now head and shoulders above other regions, with investment reaching €83.3 billion compared to just $57.5 billion for Europe and $38.3 billion for the US. China is not the only emerging country investing in renewables. Brazil, India and South Africa were also among the top 10 investor countries in 2014. Indeed, emerging market investment in renewables has been creeping up steadily over the last decade to the point at which it almost equaled that of mature market investment in 2014. It is interesting to note that structural differences exist between these two markets. While demand in mature markets is driven by energy capacity replacement, demand in emerging markets is typically driven by growth in new overall energy consumption. So, is this growth trickling down into businesses' bottom lines? The aggregate operating margin of groups analysed in the report did indeed increase in 2014 to give the best margin in 4 years. This improvement can be put down to several factors. Oversupply and overcapacity previously constrained and haunted the market, but this has reduced of late with uncompetitive manufacturers being shaken out of the market and considerable supply consolidation taking place. For example, the number of PV cell manufacturers declined from around 250 in 2010 to 150 in 2013, reducing overcapacity to some extent. Furthermore, technology and scale has meant green energy equipment prices have fallen. Indeed, falling costs are a primary element boosting investment in and supply of renewable energies. For example, solar panel prices dropped by around 75% from 2009 to 2015. Government policies, which remain decisive for the industry despite a more market competitive position, have also generally become more favourable, although admittedly this differs from country to country. In addition to this, financing and different types of financing vehicles has increased. Such developments have led to a more balanced supply-demand dynamic. If future technological advances, such as energy storage systems, are successful and prices continue to drop, renewable energies will become even more competitive on the market, possibly provoking a profound disruptive shift.